All right, welcome everyone to episode 15 of Nobody Asked Us. First thing you're noticing is Andrew is not with us today. He is sick, so you're stuck with just us two and the great Kobe. Let's jump right into Kobe's introduction. We asked Chat GPT to write you, Kobe.
Okay.
Um, Here we go. Today's guest is like the Yoda of mortgage banking, wise, forward thinking, and always ready to guide you through the forest of affordable chaos. Please welcome Coby Hakalir, VP of Mortgage Banking and Ancillary Services at T360, industry writer, podcaster, and relentless advocate for clarity and innovation. He's authored compelling pieces like Why 5% Mortgage Rates Won't Solve the Housing Crisis and urged leaders to look at initiatives like assumable loans as secret weapons in a gridlocked market. Whether he's predicting housing's future in 2050, where rentership is the rule and not the exception, or calling on mortgage professionals to stop waiting on rate drops and start building long-term strategy, Kobe sees the bigger picture and he paints it with grit and vision. From Northern California, the place he's come to love, wildfires and all, he brings nearly 3 decades of mortgage mastery, blended with a dose of Silicon Valley optimism and real-world practicality. Coby Hakalir, strategist, storyteller, and coach to buyers navigating uncertainty. Get ready for a conversation that's as empowering as it is illuminating.
Well, I don't
What are
know
your
how to
thoughts on
follow
that?
that. I can't follow that introduction. That is like the biggest buildup anybody's ever given anyone. And and it started with Yoda, which is like normally where you'd peak, but like that was the valley, and it just kept going.
It kept going.
So
Well,
I don't know what to say here, guys. I think it's best I sign off and just keep the conversation going with ChatGPT like that, because nothing I'm going to do is gonna level up with that.
well, I have spoken with you many times, Kobe, and I know you're going to live up to it. Well, before we started, we were talking about how we don't really talk about mortgage rates or Jerome Powell or things of the like. And Kobe said he was ready to check out, but we know you have a lot to offer. Um, so one of the things I wanted to jump off here, Kobe, is something that is just out of left field.
Yeah,
Um,
let's do it.
Tell people. I think some people may know this, but tell us. I mean, last time we spoke, you're like, yeah, I had to go help a lady with like a broken leg, and I was like, what? And you're like, yeah, I'm a volunteer. So tell us about that part of your life and how you got into it.
Yeah, so I'm a New Yorker by birth, from New York City, born and raised, I moved out of New York just before 9/11, and at that point I moved to Chicago for a job. I was in my early 20s, and so I watched that on TV, and I always felt like I should be giving back to the community. Fast forward 2019, I moved to California, and I didn't know anybody. Literally didn't know a single person out here. I had a cousin somewhere, but he's weird, and so we don't really chat. But that's it. Um, and
He's watching.
He's what?
He's watching. No,
Yeah, if he's watching, he knows he's weird. I've texted him that. It's not a secret. And So 2020 rolls around. Now I'm like a year into my California experience, and I still don't know anybody. But now, like, how do you get to know anyone? It's COVID, right? Like everybody's locked down. There's nothing to do socially, and I'm walking a lot because I can go outside still. And I happen to pass by the local firehouse, and I don't know if most people know this, but 75% of all fire service in this country is volunteer. And for those living in big cities, you don't feel that. So I didn't know that in New York growing up, and certainly didn't know that in Chicago. To me, firefighters were all professionals. So I saw on this firefighter house in this little town in California said volunteers needed. And so I'd had some volunteer medical training previous, and so I joined the fire department for lack of really any social life going on at the time. And I got my EMT certification in California, and I have both a wildland firefighter certification and structure fire. I went to the fire academy at like 42 years old. I was jumping out of second floor windows face first onto ladders and spinning around the whole thing. Because we have a fire problem in Northern California, as some people are aware, I got to participate in some major wildfires, one of the biggest in the state that came within a few miles of my front door, as a matter of fact. So that's been a pretty incredible experience. That was the Dixie Fire in 2021. But yeah, but from about 80% of our calls are medical. And so I think we were chatting once, and I either was late or had to run out because somebody broke something. I think it was a broken ankle that morning, if I'm not mistaken. But yeah, that's a part of me that I post a little bit about on LinkedIn just because it's affected my entire life in a really great positive way. But yeah, I'm lucky to have found that, and I'm grateful to my past self for taking the plunge and signing up.
That's awesome. Like seeing the volunteers needed sign over there and just jumping right in, Coby. That's such a Coby thing to do, though. Like, just a little bit that I know you.
Wait, so some lady just like, how do they call you, and like what's the system? Do you have like a second phone that like you get piped out all this information of like, hey, there's a lady over here, go help her, or how does that
Yeah,
work?
it's a page system, right? And so you're either on call or you're not on call. And when you get the page, the dispatch, it's a 911 dispatcher, and they dispatch and say, we've got this person who's hurt, and here's the location, and here's the response needed. And so we, those of us that are on call at that time, we respond. And pretty much no matter what you're doing, you gotta run out and take that call. That's the deal.
So you just drive over there with your car, or like you go to the firehouse and then you go there?
It depends on the situation. It depends on how quick a response is needed. If it's if it's a child who's injured and it seems a little bit more intense and urgent, I'm going to head there straight in my car because I'd rather just get there and do what I can to help. But the protocol is to meet up at the station and go. But if it's a fire, for sure, because I'm not going to go to a fire in my car, with nothing. But if it's so it's a situational basis, and I kind of make judgment calls now that I'm 5-6 years into it.
Sick.
Well, so now we have to follow you being called Yoda, to giving back in the greater good of volunteering, to let's talk about profits.
Which kind? PH or FI? Which are you talking about? People that can tell the future or people that make money?
People that make money. Yeah.
Okay.
Well, before we do that, can you talk to us about T360? And then I guess before that, how did you get into the mortgage industry? Because Andrew always says, like, nobody's like, in elementary school, what do you want to be when you grow up? Doctor, lawyer, nurse, mortgage executive. So how did you get in or get sucked into the mafia here?
Yeah. So Andrew's going to be disappointed to learn my story because I actually started in elementary school. So my mother got into the business as a mortgage broker in Brooklyn, New York. I think it was either 84 or 85. I was still a little boy at the time. But as I got into either 5th or 6th grade, it may have even been 7th, but somewhere around there, I started after school. I had this really super long bus ride home from school. And at the time, based on attendance, they would put you in a school and they gave you a bus pass. You had to, make your own way to school in New York City. And I had this super long ride, and my mom's office happened to be about less than a mile away from the school. And so rather than take the bus home, I would go to her office after school because then she would give me a ride, right? Well, I got there. My mom was like a workaholic and was nowhere near done for the night. So she was like, well, you can sit here or you can help me. And so I started helping her package up FHA loans to send to the underwriting center in Atlanta, which was what you did at the time. They had these regional centers and you put them all in order, and it had to be in the right order. They would send it right back to you. You sent it there, and like 50 days later, they gave you an underwriting decision. And it was, the height of technology. And so I was packaging up these credit reports and credit packages for FHA when I was, in 7th grade or something. So that's how I started in the mortgage business. Did I envision then that I'd still be in it, talking to you guys about it, 55 years later? No, but that's how it wound up.
Okay, that's a different kind of origin story than I've ever heard. That's a pretty young one. You beat me.
Yeah.
Chris. Yeah, I was gonna say he beat you there.
Yeah. And then how has it come? Tell us about T360, and then how you joined there and what you're working on there.
Yeah, it's a good story. So when I moved here to California, the idea was to relocate west, and I was working for U.S. Bank at the time. And so the first thing to do, I was still kind of managing, regions in Milwaukee and Chicago, and I came out to California, and the idea was to transfer out to the West Coast. I had some family reasons to be out here. And then COVID started, as we've talked about, and there was no transferring anywhere. Everything was shelter in place at the time, and U.S. Bank was too busy, processing 8,000 refis a day to like make those kind of structural changes. Everybody was just triaging at the time, figuring out how to send everybody home to work, and then at the same time how to get all these loans done, right? Because everybody was just bonkers busy, and so eventually it became a thing where I had to live in California, but commute back to Chicago every other week. And that became a little unsustainable. And I was kind of growing a little bit less and less enamored with the corporate life, even though I love US Bank at the time, I still do. But I started to think about, as I was volunteering for fire and the world was changing. And I was like, I really want to do something a little bit bigger with my career, and I want to impact the industry in a little bit different way. And a friend introduced me to someone at T360 who, as the universe ordained, lived a half an hour away from me in Northern California. And so another one of my T360 colleagues, and he said, hey, we've been looking for someone to kind of, head up our mortgage vertical. And I said, hey, I've been looking for, a place where I can have a completely different viewpoint of the industry and impact it from a totally different standpoint. We spent about 8-9 months talking, and eventually I joined. So I've been there a little over a year now. And it's everything that I envisioned it would be, which is fantastic. Super happy there. Great organization, super smart people, the biggest strategic advisory firm in real estate brokerage, and now we're starting to cross over into mortgage quite a bit.
And that's what you're doing there, right? You're heading up the mortgage part.
Yeah. And funny enough, when I got there, I said, look, this and something I've always felt very strongly about. I was a part of the Chicago Association of Realtors for a decade. I was the chairman of their philanthropic and education foundation. I served on their board of directors. I have always felt like real estate and mortgage were just one big housing ecosystem, and that's the vision I shared with T3. And then, like 2 months after I started there, Rocket buys Redfin and Mr. Cooper, and everybody's, consolidating, and the industry just starts overlapping into this one ecosystem. So it's been a pretty cool ride.
So for T360, for the people, like, what would be your ICP, or like people that would be looking like kind of like help plug Coby here a little bit? Like, what is your ideal client and people that you look to engage with, and like what core services are you guys offering from your chair?
Yeah, funny that you say core services, because that right now is the product that I'm working on most prevalently. I'm working with our technology vendors. I'm working with that are in the prop tech and mortgage tech space. I'm working with our real estate brokerages, but I'm working with the real estate brokerages mostly in the vein of if you have ancillary or core services, as we like to call them, core services being mortgage and title, ancillary being everything else, aside from that, insurance, home warranty, et cetera. If you've got it and it's not working, you don't have the attachment rates you want, we're going to help you get through that with both a consultative approach and a tech approach. If you don't have it and want to stand it up, we'll figure out what the best method for you to do that, whether that's an MSA or rolling straight into a joint venture or franchise model. And that's where we're helping, because the real estate brokerages, they don't have refinance to rely on to save their bacon, right? They are living in an era where they're seeing compressed margins on bottom line revenue. They're paying their top agents all of their 100% of their commissions that they roll with that volume and make some transaction fees. Their cost of business is going up, and so they need to have other lines of revenue to generate off of the leads that they're ingesting, and that's where mortgage and title and insurance become so important for them.
So with all these prop tech companies and the AI platforms like promising to, like, everybody's going to revolutionize housing, what innovations are actually moving the needle? And are there any that are just hype, or there's things actually moving the needle right now?
On the mortgage side?
Mm-hmm.
I think
both sides. I'd love to hear both sides. Yeah.
Yeah. I mean, on both sides, I think it's the same thing. I think the companies that miss the mark are the companies that proclaim that we're going to have the bulk of your interactions with your customers, because I think customers don't want that, right? They want some of that convenience. But if you go on a website, how excited are you that a chatbot is like, "Hey, I see you're looking for a house." It's like they don't want that. At the same time, you don't necessarily want your phone to ring either with a live person, right? So I think finding that balance with customer interaction, it's still not quite there yet. Where I see AI really helping companies is, for example, on the mortgage side with document reading and extraction, that's helping efficiency. On the real estate side with pulling out data from the documents that are involved in the real estate transaction and allowing these data points to be actioned, transferred to a CRM, helping people stay in touch with customers post-close. All of those things, I think, are providing a little bit of relief to the businesses and to the customers, where they're taking just this mountain of paperwork and mountain of data and streamlining it so that it's actionable, it's understandable, and it's not creating headaches. And I think that's where we're going to see the biggest win for this kind of merging together of real estate and mortgage, is in the fact that we now can have much more easily accessible and actionable data because of that technology. I think that's where the biggest wins are. Some of the things that I really love that I'm seeing. I have a friend, I know, Chris, your company, I really love what you do, because you're trying to simplify the mortgage process. And there's companies like Addy AI and Guideline Buddy that are trying to take some of the guesswork out of figuring out investor guidelines on the loan officer side. So again, that's on the backside of the operation where I really see efficiencies being created, because the number one thing the mortgage industry can do to help itself is to reduce the cost of manufacturing a loan. And the easiest way you can do that is by implementing the correct technology to help you become more efficient. The mortgage industry needs to get out of this cycle of firing a billion people when rates go up and trying to rehire the world when rates drop to a certain level. It doesn't work, right? I mean, it's bad mojo, number one. Number two, think about the cost of bringing all these people on board, having to retrain them, because the technology has moved in the last 6 months or a year, or in our case now 3 years since you fired them. Finding the talent, because at some point they're going to go to another industry, right? And we're not going to be left with the best of the best if you keep firing them, right? At a certain point they're going to get sick of that. And on the real estate side, I think it's finding that balance for keeping that customer engaged. One of the things that we do collectively on the real estate and mortgage side is we lose about 80% of our return customers, right? 80% of our customers close a deal with us, they never come back, right? That is abysmal. I mean, absolutely abysmal, especially when you're in an era of compressed transactions and compressed margins. You need to get those people back. The cost of getting new people in over and over and over again, that's going to break you. And so we're doing a terrible job of keeping that post tail and that post funnel alive and well. And if we just move that number from, 20% coming back to 40% coming back, that's a huge step in the right direction, and doesn't even seem that aspirational of a number to get to.
Is that number from both the mortgage side and the real estate side?
Yeah, on average. I would say it's a little bit different for both, but that's a good solid number to use in conversation.
So it seems like your take would be that, well, I love one thing you said about, I love how we are in a cyclical industry, and everybody talks about and acknowledges that it is cyclical when rates are not great. When rates are great, everybody forgets that it's cyclical. Like it's never going to change. But when it's bad, it's like, guys, hold on, it's going to come back.
And then it comes back and people stop innovating.
And then that's the other thing about innovation is you go from, hey man, times are slow, we're kind of tight on budget, now's not a good time, let's wait till we get some more business coming. And then business comes in, and then they say, well, Coby, now's not a good time, we're really busy, we got a lot of volume now. we fired everybody from before.
Yeah, they either don't have the time or they don't have the money, right? And I feel for my brother loan officers and sister loan officers that are out there, because I know what it's like to go from, feast to famine, right? I've been a loan officer. I managed loan officers for a long, long time. But at the same time, there's more market share for those LOs that are in the business, right? I want to say the median income for a loan officer right now is about $43,000. That's the median income. The Pramod did not like that stat at all. He was either scoffing at me or I just bored the crap out of him. I'm not sure.
I have a take on this. I'll tell you after this.
Hey, Coby, those typical San Francisco youngsters, man.
Yeah, in the most like prototypical work share industrial little complex over there. Like, I could throw a dart south of where I am and hit one of those. But the top 5%, the top 25%, they're still making money. The top 1% are closing over 75 million a year in volume. The top 5% are like 35 million a year in volume, right? And the top 25% are still over 12.5 million a year in volume, which is a 6-figure income in most places, right? So if you're in that top 25%, you're still making 6 figures. You're gaining market share because the lower loan officers that were picking off a deal or two here and there, are no longer in the business.
Right.
What you've got to worry about is focusing on those realtors that are doing business, right? And so you've got loan officers that are looking to less realtors, but those less realtors are doing more of the business too. So it's actually a good time for a lot of loan officers to figure out who their targets are on the referral partner side. And it's a great time for mortgage companies and real estate companies to be innovating and thinking about how we can dive deeper with the databases we have and how we can create more value. There's still 4 million deals being done a year.
All right. So I'm hiring Coby right now. And I say, Coby, I've got these 4 clients and they keep telling me they don't have time or they don't have money. Like, what is your kind of approach? What do you tell an executive to just kind of, gloves off, just like, hey, man, here's my advice to keep innovating and preparing for a year or two from now?
I mean, the advice
or
is
longer.
Simple. If someone right now is thinking about how to beat the crap out of you, right? And they're figuring out how to get the money together to put you out of business. And if you're not thinking about the same thing, if you're not trying to stay ahead of that competition, you're going to be lost, because we've seen it. We've seen a lot of IMBs either have to merge with somebody else, get acquired by somebody else, or just flat out go out of business. So if you're sitting around waiting for a refi boom to happen, by the time that refi boom happens, you're not going to be able to find the people to work for you to handle that volume. And you may not be in a position from a rate perspective to be able to win that business, because at that point, now you're selling a commodity. And if you're not executing from a rate standpoint, I know you don't want to talk about interest rates, but if you're not executing from a rate standpoint or from a service level agreement standpoint, you're going to be out of business then. So, it's either start swimming now or die either a slow death or a quick one, depending on the market.
Also, I think I'm sure you guys see this too, but like you have all these people on LinkedIn that are either throwing rocks at like the UWMs or the Rockets or one of the big.
I've thrown some.
Well, I just think it. And Coby, I think you and I have traded some comments on LinkedIn about this too. Which there's like, I guess, like the legal and maybe political side of things, but like at least from a tech perspective, they invested for a decade or longer in some cases. Like Rocket's been around for a while, so I think it's kind of unfair to like for someone who played a short-term game to look at somebody who played a long-term game and got their reward and say, oh, they're being unfair, or they're this, they're that. Versus like, if you're willing to play the long-term game and you were to invest in technology in your people and build like a 40-year organization or 50-year organization, you'd have different set of results. You'd play the game differently than somebody who plays for a cycle, for example.
Yeah, look, I mean, I'm a New Yorker, right? So I'm a Yankees fan. And despite the season they're having right now, or the last like 5 years, historically, they've been the franchise that people look up to and they hate. The same thing with the New England Patriots. And so when you've built a good organization, when you've built a good model, when you are, a dynasty or an empire or whatever the word you want to use, people are going to look to you and they're going to try to poke holes in what you're doing. I've had issues with UWM on certain things they've done, but I'm the first person to talk about how UWM has built an 1,800 person IT department, and they are constantly thinking about how to be the best. They're constantly thinking about how to win in the market. Some of their moves might, in my opinion, be overreaches as far as their gaining market share and how they work with some of their brokers. But you have to tip your hat to them for the things that they've done and where they've come. For a wholesale lender to now be the number one lender in America and to knock all of the top banks off of that perch, and for the market share that they have is extremely impressive. And I can say the same thing about Rocket. And if you just look at the risks that Varun took with, the Redfin acquisition, Redfin was a real estate company. He basically bought 50 million eyeballs a month. That's all they were. They weren't a real estate company they weren't a model that was making money. And then to turn around and put Mr. Cooper in there, recognizing that the future of dominating mortgage is through servicing, how do you not look at those moves in admiration and think about, well, what can I do to emulate that? And I think you saw that with Bayview and Guild and Lakeview Servicing trying to put together a mini version of that. And so I applaud what they did, because they looked at it and they said, okay, you know what? That's a hell of a good idea. Let's do that. And I think you're going to see a lot more of that from the people that are trying to gain some traction in this market.
So following this discussion so far, Coby, you mentioned about we're only getting 20% retention rate from previous customers, right? But then you just mentioned 2 giant transactions where their whole goal was to get customers that they could reacquire. And you just hit on something else where if you're not if you're not one of those people aggressively trying to get that 20 to 40, then those guys, I mean, that's got to be their playbook, right? I mean, if you're behind the scenes and if you're a fly on the wall, what do you imagine those guys are saying about their recapture rate?
The Rockets and the Bayviews you're talking about?
The Mr. Coopers and stuff, yeah.
Yeah, I mean, they're if you listen to any of those conversations, you will hear the recapture word over and over and over again. And most lenders think about recapture as a loan being sold, having to buy a loan back and recapturing commission. But the real recapture word is really retaining that customer. And if you are a loan servicing company that has that inside track to that customer, and you can control the communication, you can control the narrative, and you're doing a good job, because most customers either have no feelings about their service or negative feelings. But the ones that are doing it right, the Mr. Coopers, the Lakeviews, they're in conjunction with the mortgage companies whose loans they're servicing, they're doing a great job of recapture. They've figured out how to talk to those customers and keep those customers engaged and provide those customers with valuable tools. And it goes so far beyond just, all right, we've closed your transaction, and now I'm going to tell my loan officer to text you a happy birthday or a happy home loan anniversary in 9 months or 12 months or whenever after the closing. And we're upping the game. And so if you're an IMB and you're looking to be a major part of the landscape in the next 10, 15 years, you better be thinking about upping your game. And so I love what Gil did, and I love what Rocket did, and I love what UWM's doing. And I love the fact that the brokers have went from like less than 10% market share to now at 25, closing in on 30%. I think that competition and that pressure on the entire market is fantastic for everybody, and I want to see more of it.
So, PK, were you about to ask something? Because I've got one for Coby.
I lost my question. I think it was around the whole innovation.
Coby, yeah. Coby, if you had to place a bet on whether or not the next big disruption in mortgage, do you think it will come from an outside player, like totally out of left field, like a Google, Apple, Amazon, or will it be within the industry?
There was a long while where I thought it was going to be Apple and Amazon coming in. I'm pretty sure I've even posted about it at some point. Where I think that has landed now is we're in an in-between era of compliance and regulation. Right. The CFPB has been dismantled for the most part. No one's quite sure what Fannie and Freddie are doing regarding, how they want to approach the market and where they're headed. And I think because of those two things, I think the bigger outside disruptors that may have decided, hey, we want to come in and try to be a major player in mortgage, I think they're taking a step back for right now and trying to figure out, what this really looks like. Does the CFPB eventually get rebuilt? Can the mortgage industry behave itself during this time of lowered regulation so that if there's a Democrat Congress that comes in, that they're not spurred to action and say, hey, we need to reinforce the CFPB because everybody in mortgage is misbehaving. So I think the players that are outside of the industry right now are looking at the industry to see how we're behaving ourselves. And a few lawsuits that I've seen that seem like they've got little to no merit and may just be, lawyers being lawyers. I think for the most part, I'm seeing the industry behave themselves. So where do I see the next biggest disruption? I see it from within. And I think we're seeing it. I think UWM at some point, they're going to make a move, right, to try to take away some of the headlines from Rocket. And I think they're just probably looking for, that real estate company to acquire right now. And I kind of feel like they're, again, I'll make another baseball reference. Growing up in New York, anytime the Yankees did something, the Mets would try to take back the back page. And I can see Matt Ishbia just kind of thinking about every day, well, how do I take back the back page? So I think that's where it might come from. And I think we're going to see more consolidation of real estate and mortgage because it makes sense. I think both sides need it. And I think the total funnel of the customer initiative has legs.
And Coby's there to help you do it, right?
Potentially. Sure.
Potentially.
So, what Mortgage Yoda over here? What is a tech trend or sentiment that you think is total BS right now?
Oof, that's a question that's going to get me in trouble.
Oh, that means it's a good one.
A tech trend, I think the tech trend is trying to build too much from the mobile app standpoint. I see a lot of companies that are, still talking about how they're building a really great mobile app for, that the realtors can log into, that the buyers can log into. I think people are tired. There's app fatigue out there. And I think that we're misjudging to an extent the amount of technology that Gen Z and the millennials want to use. I think that they want to use technology to the point where it gets them, it gets a lot of the initial stuff out of the way, and that data can then be used in multiple places without reentry. But I think they still want that human guidance. They still want that loan officer that can speak their language. They want that agent that can speak their language. And so the tech trend, I think that is just an overall trend of misjudging the younger generations and thinking that they want more tech on the customer facing side than they really do.
It seems like it needs to be, there's different buyer personas we have to cater to, right? Because like we've talked one time where I love a chatbot, but like only when I know it's entry level stuff. So I'm like, I just bought an electric bike, and the display came and it was cracked, and I was like, sweet. And I went to the website and they're like, real agent or chatbot, and I was like, I have a cracked screen. Here's an upload of it, blah blah blah. And it was like, cool. Here's a FedEx. We're gonna go ahead and just give you a new one. We see that it just arrived today. No human interaction. That was great. If it would have got any bit more sideways, I would have been like, give me human. The same thing for mortgage.
Yeah, and you're right about the personas. I mean, you're mostly chatbot at this point yourself, right? So, so we have to think about the source, right? And where that comes from, and I think that if it was me, I'm pretty tech savvy, but I'm not Chris Mace, and so I probably want the real person to be like, hey, my screen is cracked. Layer on top of that what it feels like if you're doing a transaction that's $400,000 or $500,000, right? And we buy consumer goods all the time. Things break. We know that dealing with Amazon is pretty good. Like they'll take back anything. Same thing with, you can bring your stuff back to Costco. But when we're doing a transaction that we maybe only do once or twice or three times in our lives, that's scary to us. And if you're a Gen Zer, it's especially scary because you watched your parents either lose their home or lose value in their home during the Great Recession. And so we're talking to these folks about, hey, this is the way for generational wealth. You're going to be 40 times wealthier as a homeowner than a renter. And it's like, well, wait a minute. That was not my experience as a child. That's not what I went through. And so we have to respect those personas, and we have to talk to those personas differently, and we have to adapt to their needs as opposed to trying to, guess what they want. And the mortgage business is making a lot of guesses right now about what those people want. If you think about where Rocket sits, right, they are betting on a very tech oriented experience. Guild is more about boots on the ground and the community loan officer and meeting people out in the Little League park and doing the traditional thing. So we're making a lot of guesses. And part of the reason we're making a lot of guesses is because we don't have a lot of youth in our industry. And that's a big problem that I tend to talk about quite a bit, especially as I hurtle towards the 50-yard line.
So, my next question was going to be about what's the tech trend you're bullish on. So I'm going to come to that one though, so you can prepare for that. But I do think it's fascinating, Coby. Like if your kid was buying a house, so I get, I've given some of my friends shit because I found out like this was a few years ago. He's like, yeah, we just bought a house, and I was like, oh, why didn't you tell me? He's like, oh, well, the realtor had a loan officer that referred me, and the guy had no closing costs. And I was like, yeah, okay, no closing costs, but what was your rate? And it was literally, I think it was 3/8. The rate, not cost, rate, worse than like some of the lenders I work with. And I was like, you know what I do. Why would you not call me? He's like, oh, it was just kind of, I don't know. They already pulled my credit and it was already, and I feel like we're in this world where we have to encourage them to also shop. But I see all these mortgage lenders, they don't want anybody to shop, right? It's like, no, it's my deal. And trigger leads go too far. But like, I know you, Coby, if your daughter's like, hey, I'm going to go shop for a mortgage, or I want to get a mortgage, you're going to be like, hey, we're getting quotes. We're getting a few out there. Or what are your thoughts on that? If everybody's like, I think my lead should be mine and mine only. And yeah, talk about that a little bit about.
Well, I mean, there's always going to be a dichotomy in just about every industry between what we talk about when we're doing consumer education and what we're talking about when we're trying to get a sale. And when we're trying to get a sale, right, it's gloves off. I want your business. You don't need to talk to the other guy. I've got the best deal. Here's my value, right? And then when it's consumer education, it's like, the first time buyer seminar, if you're a loan officer and you're leading one, you're going to tell them like, oh, you want to make sure you're shopping for the best rate, and feel free to send me your good faith estimate because I'll match it. And then when you're a loan officer and someone sends you their, well, they used to call it the GFE, now it's the LE. If someone sends you their LE, right, you're like, damn, I don't want this. Like, now I have to deal with this and figure out like, line by line, who's got the, you've now been reduced to fighting over a commodity. Right. And, I think that we say one thing, but we do another in real life. We certainly don't make it easy for customers to shop because we can't give a good faith estimate as easily as we used to. You've got to trigger certain points for an LE. Most lenders don't have sample LEs to send out, or they make it difficult to get a quote LE generated through their system. So I think in terms of meeting customers where they are, we're still doing a poor job of encouraging them to get the proper education before they enter into the process. And we're still very pushy in terms of, from the realtor side, from the mortgage side, of saying, okay, here's the deal. You're not going to get a better one. If you're going to have to go through, half the process you just went through with me to get, just another quote. And if you go online and get a quote by clicking a few buttons, well, how that quote is not really reliable because you didn't give them as much information you just gave to me. So we've got some work to do there. And I think that we'll eventually be forced to do it because the customers are getting smarter, and they're going to want it. We have had this notion for a long time that, we started to tell millennials that we call millennials lazy, right? And what we didn't realize is that, the millennials are on their game. Right. They are 100% on their game. They are much more likely to go to YouTube for their information than they are to you, Mr. Loan Officer, but they know what they're doing. And when that message didn't make sense and we couldn't square away why the millennials, knew so much, but, we kept calling them lazy. And then we pivoted over to Gen Z, and the only thing worse than lazy that we come up with to call Gen Z was disinterested. Right. And so we started saying like, well, because I can tell my daughter to clean her room, but if she's, and she may want to, but she's lazy, but if she doesn't care about cleaning her room, now she's disinterested. Right. That's a layer even worse. And so we've just started naming the generations, trying to figure out what's wrong with them. Meanwhile, they're just like us, except they have access to more tools and more information, and they're really smart about getting it. And we're going to have to adapt our industry for that paradigm.
So that's. Do you have any thoughts on a tool that could be built for borrowers? I've joked about, like if you were going to like make a tool that would be for your daughter to try and navigate this environment. Anything come to mind?
I mean, there's a few. I mean, there's I don't want to give plugs for specific technology out there because some are clients and I don't want to be shilling for people on your podcast. But one guy
will give us the kickback. Talk about it later. Go ahead.
Yeah, I mean, well, I can talk about my friend Brad Blumberg, and Brad, he's not he's not a client of mine. He's just a friend. And I happen to really like Astra Key, this kind of non disclosing way of going out and shopping for a mortgage without having to give up all your data. I love that. It takes the bias out of it. It takes a lot of the heavy lifting out of it. There's another product that's also not a client of mine. It's called FinCast. My friend Benjamin Shakin, he's got a really cool app that you can use with anything from car lending to home lending, where you can go out and get multiple quotes and shop relatively without getting scarred in the process. And I think the biggest pathway to that right now is the recent trigger leads ban, because I think that's going to make it so much easier for a customer to have confidence that I can go and shop and my phone's not going to get blown up like a crazy X for the next 3 days. That's a huge win for the industry that I think we're talking about quite a bit, but I don't think we're thinking about all the implications of it for our market, and the implications are huge.
Well, can we share a little bit about the trigger lead? I mean, I think there's a lot of people who gave up on it. I think there's a lot of people who are surprised. But what are some of the things that are still in there? The not to say loopholes, but kind of the caveats or cutouts. Like if you're an existing lien holder, you can still get it, or can you share a little bit of this?
Or if you've got a banking relationship.
Okay.
So if I'm, I think those are the two carve outs right now that I'm aware of, which are pretty good. There was a servicing carve out, but I think that got eliminated.
Okay.
So IMBs can't use them basically.
Or it got folded into the relationship part of it. But it's limited. It's not 100% iron proof, but it's way better than it was. And the result, I think, is going to be, such a win for the industry. Someone asked me, because I posted about it on LinkedIn, and someone asked me, I think it was Larry Silver. He said, "Is this going to get?" Shout out to Larry. He said, "Is this going to make things cheaper or more expensive for the consumer?" And I said, ultimately cheaper, because think about how many consumers put a loan application in, then got what's the word I'm looking for? Sniped by a trigger lead and wound up paying more for their loan because of someone's unethical practice, because they promised them a lower rate than their friend, the loan officer, had given them. So I think ultimately it's going to be better for the consumer in just about every way, and cheaper for the consumer, and it's going to put the right kind of pressure on the industry to create a better shopping experience for people, and not one where we're just like telling them, hey, don't answer your phone for the next 3 days because it's going to be someone trying to rip you off.
Well, so
just so I understand that real quick, but you're saying that the banks can leverage trigger leads, but IMBs can't?
I think so. Yeah. If you have a banking relationship with that person. Now, just because you can doesn't mean you will, and doesn't mean you have the mechanism to be able to do so. But I think the reason they had to protect that is because they had to protect the bank's ability to be able to communicate with their own customers.
It's existing, but IMB could still do it, PK, if they were the last person to close the loan.
Correct. Yeah, that's considered to be a relationship too. Yeah.
Gotcha. Okay, makes sense.
Yeah. What's funny though is I was talking to Kristen Broadley, shout out to her, and she, I told her in 2009 and 10, we were slaying trigger leads, and we were saving people money left and right, but nobody else was doing it in our whole, like in our demographic. They're really the only person, other people that called. I think it's become a lot easier 15 years ago, like from there to now, to where you do get pelted. So what is a tech trend that you are bullish on, Coby?
Yeah, there's one that I really like, and I see iterations of it in both real estate and mortgage, and that is the AI powered CRM. I know nobody wants to hear CRM as anything bullish, because the traditional CRM is just like, well, who uses it? Who cares? But the AI powered CRMs, where there's propensity scoring within those CRMs that actually lead you to, like, hey, this is somebody who may be listing their house soon. This is somebody who may be ready to refinance based on 5 different factors, and not just like their arm is expiring, but real good data that gives propensity scoring that's actionable and leads people to where to focus their efforts and attention. Super cool technology. It's only going to get better, every single day, and I think that that's going to be a big win for both industries. Or share the data. You've got somebody's data for a buyer is somebody's data for a mortgage, and it should just be living together at this point. But I love the propensity scoring models that are actually working, and I love those that lead to also individualized marketing for those customers too. So instead of sending out the Happy Halloween poster, you're sending something out that actually resonates with those folks. So I think that's what I'm most excited about, because I'm seeing that improve, and I'm seeing the brilliant minds that are behind some of that innovation, and I'm super excited about it.
And getting that back to that 20% higher. I mean, because you think about mortgage and a CRM, like a CRM, like I think of a way a bank uses a CRM, like customer relationship management. Like, what are the different aspects I'm managing that relationship with that customer? But mortgage, I know, a lot of people will like to say it's not transactional. It is heavily transactional. Like, yeah. I don't want to have a quarterly meeting with my loan officer. I don't. I'm sorry. Like, but like, propensity. All right, I got married, I had a kid, or some of these things. Like, I might be interested in doing that. Then I want to talk to you. Like, I don't want your birthday card. I don't want your mortgage market updates. I don't want, any of that stuff.
What about a recipe?
That's the fault of the mortgage industry, though. Because if I was your financial advisor and I told you I wanted to meet with you quarterly, you'd be like, all right, that sounds great. That's the fault of the mortgage industry for creating that perception that we have nothing to talk with you about, and we have nothing to add value in your life after you close a home loan. We've done that, and we've created that. Whereas the Morgan Stanleys and the Charles Schwabs of the world, like they're invited to your family barbecue, right? Why aren't we? We've done that in the mortgage industry. So that's something that we have the power to correct if we do it the right way.
So you're saying that the mortgage loan officers should try to operate more than the mortgage transaction?
Yeah. Yeah, I mean, you said CRM, customer relationship manager. The first thing popped into my head was, no, it's not. In mortgage, it's a customer transaction manager. We're not managing relationships. We're managing transactions, and we treat them like transactions. And why do you think 80% of them walk out the door and never come back? So the post tail, the post funnel, where we're losing all these people in droves, we've created that in mortgage where they don't remember our names. And we think if we send them a fridge magnet, that's going to do something. But think about the dashboard tools you have. Think about the dashboard tools you have if you have a financial advisor relationship with a Merrill Lynch or a Charles Schwab or a Morgan Stanley, right? You can go in and you can see what your investments are doing. You can see exactly, where your money is. If you have questions, you can talk. You can have a meeting scheduled with that financial advisor. You can develop a relationship with them. You may have, $300,000 in an investment account, and you've got an $800,000 home, right? That's a 2.5 times bigger investment. Why are you not having that same relationship with your loan officer? Whose fault is that?
So maybe with all the changes that are coming down the pipeline, the career needs to pivot into something a little bit more.
100%.
Perfect timing for all of
that. The problem that we have is that we're not hiring anybody new into the industry. So who's pivoting? I'm 47 years old, and I consistently, from the time I got into managing loan officers in 2007, when I was 30, I guess, right? That makes sense. I was younger than just about everybody I was managing. That never changed.
Oh, wow.
That never changed. When I was 18, 19, working at Fleet in West Hempstead, working at Fleet Bank, I think I was 19. I was the youngest person in the office. That never changed. I was always the youngest person in the office. And who's pivoting there? We're not hiring the younger generation of loan officers. We're missing out on the opportunity to pivot that career to something more like you just said. And worse, we're missing out on an entire future generation of leadership. Who's going to lead the mortgage industry in 25 years from now?
Are you saying that there's no young people coming into the industry, or is it just because we don't see them on LinkedIn?
I think no is no young people is probably a bit of a harsh take. But I think it's nowhere near the number it needs to be. When I was coming into the business, banks were still hiring younger loan officers and training them. There were training programs at IMBs. There were training programs at mortgage brokerages, just like they train real estate agents at real estate brokerages when they have signs that say every Wednesday, and they bring new people in. The mortgage brokerages used to do the same thing. 2009, 2010, it became too expensive to do that after that because you were spending more and more of your money on compliance. We stopped bringing younger people into the industry. We've not started. Are there younger people that come in? Yes. But is the mortgage industry going out to college campuses and recruiting people into our career? Absolutely not. And so people are getting in a lot of the same way that I got in through legacy, right? But they're not getting in because we're broadcasting this as a great career choice for younger people. And that speaks volumes about where the future of our industry is heading.
Well,
so new LOs coming into this, or existing ones, like if you could teach them one skill to advance their career and make them successful as a loan officer, what would it be?
New LOs coming in?
New LOs and then existing as well. Like it could be tech related or non-tech related.
For me, it's always anything I've always been teaching my loan officers for the years that I was managing, and I managed loan officers for over 20 years. It was all about protecting those relationships on the customer side, on the referral partner side. It was all about going, an inch or two wide and a mile deep. And I think a lot of loan officers make the mistake of trying to have 55 realtor relationships, a huge CRM of customers that they've got on a marketing database. They're not going deep on those relationships. They're not building loyalty. They're not building a legacy business. So I think that'd be my advice. Was if I was giving myself advice coming into this business, I would be like, pick the people you want to work with and drive those relationships and build those relationships and make sure your customers remember who you are 6 months, 12 months, 18 months after the transaction. That'd be the advice I'd give myself as a younger loan officer. And I'd be, making millions now.
Yeah, I've seen I looked at some of these AI platforms that are like, recording your calls and they can kind of dump data back into a CRM. And I was curious, I was like, if I was a loan officer, I would want to have a realtor category where I could identify how much time do I spend with realtor per transaction? Because, I think in mortgage, Coby, you may have seen some of these mortgage companies are finding that this big branch, the mega branch that they think they need, when at the end of the day, the branch is not as profitable as, a mid-sized branch that they have.
Yeah. Yeah, I've seen loan officers make that mistake throughout my career. We spend a lot of time with the people that we like, right? But we also spend a lot of time with the people that make it easy for us to spend time with. And so, oftentimes, as a loan officer, you wind up spending a lot of time with a real estate agent that's not giving you a lot of value back because they're giving you that time and attention, and you're not prioritizing the correct relationships. And you're wondering why, yeah, I've got 20 realtors that I talk to, but I'm only getting deals from half of them once every quarter. And it's because they're not evaluating those relationships correctly. And one exercise I always used to do was have loan officers rank their relationships A, B, C, D, right? And I know there's technology now that can do that, but that's something that any loan officer needs to be doing, is reevaluating those relationships and figuring out who am I spending time with and what return am I getting on my time. And I think that's an exercise we could do personally too, right? I mean, I think we should all be evaluating who we spend time with and what the return is. We're the average of the 5 people we spend the most time with, right? So why not spend the time with the 5 best people we can find?
All right, Yoda.
He's got all his motivation in him.
Yeah.
Boy, I had a lot to live up to in that intro, man.
All right, so I wanted to ask. This is good that because what you just said kind of comes in from our guy. I don't know if you've heard of Closing WTF or if you watched last week's, but he kind of built a platform that ingests loan estimates to try and help you identify whether or not you're getting overcharged or whatnot. But here's his question, and tell me if you can hear this. We're gonna hitting play now.
Has the broker paradigm shifted? How is it different than it was 20 years ago? And do you think it's going to be different than in 20 years from now? I mean, there's the need for brokers is inherently trust, but has the fundamentals of trust changed?
Did that come
I
through?
assume he's talking about mortgage brokers.
Yeah.
Yes.
Yeah. So his question is, do the mortgage brokers have a future? Is that kind of what he's asking?
I think it comes as let's read it. Let's kind of. Can you tell? I'm going to play.
What did it look like? Yeah, what did it look like 20 years ago? What does it look like, going forward?
Yeah. I can answer that. So 20 years ago, it was a complete and utter mess. We were heading in. If you look at 2005, the brokers were pretty much doing, and a lot of banking was doing this too. The brokers took the brunt of it because they had less advocates and less money than the banks, right? But so the brokers took the sharp end of the stick on this. But the entire industry 20 years ago was in the process of losing the entire trust of the American people through the loan products that we were lending on. And that really, and that's not to lay blame. That's just a function of what we were putting out there into the market. The blame is all over the place for that. And right now, if you fast forward 20 years, the brokers went through hell. They went through hell in 2009, 2010. They went through hell again during TRID when they had to disclose their comp in a different way than the retail bankers do. And now 10 years later, the brokers are emerging as kind of this quiet push on market share because they've got tremendous tools behind them. They've got resources behind them. They're getting smarter. They're getting more savvy technologically. They're winning back the trust. They're almost, like I mentioned earlier, at about 1/3 of the market share in this country. And I see 20 years from now, I see them being, at 50% or greater, putting tremendous pressure on the rest of on the other channels. So I have a lot of confidence in where they're going, just because they're innovating, they're building, they're getting savvier. And it's not the same mortgage broker as it was, back in 1985 when my mom was doing it, and all she had in her desk was, that desk planner with the calendar on it and a telephone. It's just a different world now, and the brokers have done a great job of adapting to that technology, and the wholesale lenders have done a great job providing a lot of the technology to their wholesale brokers. So the future for them is very bright, in my opinion.
So,
wow.
What are your PK and I have talked about a mortgage platform that would be, I don't know that we would get UWM or UMortgage to sign up for it, but they've done a really good job of, like you said, Coby, making these kind of platforms, right? Because we're seeing kind of a little bit of a rise of brokers that are I send my loans to UMortgage, right? Or I'm a broker and I send my loans to UWM. What are your thoughts on that? And how could technology help these guys be able to better kind of give their people more options with different companies?
I think for the most part, they are giving options. They do have options for different companies. It's just the companies that are at the top of their game right now are making it hard for those brokers to want to pivot to another company. They're making the loan process easier to navigate. The pricing is incredible. The incentives to generate more business, drive their pricing down even further. So they've created this great environment for these brokers. The people that are out there complaining that there's a broker giving business to one lender and not another, well, it's like the brokers are savvy enough and independent enough to recognize that they're going to they have incentive to give you their best deal. And so it's not because they're getting a UWM coffee mug at the end of the month. It's because UWM is making it really hard for any competitor to enter that market. And kudos to UWM for that. And so I think that if you want to get into the broker space and put pressure on Rocket and put pressure on UWM, you've got to provide state-of-the-art, best-in-class technology, and your pricing better be sharp. That's how to win.
Kind of like getting mad at a realtor for always sending their loans over to Coby. Like, you send all your loans to Coby. I want to try.
Yeah, of course I do. He's Yoda. Why wouldn't I?
When I was Coby, when I was at my last back home in Arizona, I was at not a WeWork, co-working space, and I would meet.
Of course you were.
Well, I would meet these brokers in that space, and I would ask them where they're sending all their business, and a couple of them were like, "Oh, I just sent all my business to UWM. I don't even think about it, right?" And the more I dug into it, really, ultimately, they've got to put food on their families' tables. And they're like, the reason they send it, even if UWM is more costly and maybe the rate's a little bit higher, is that they have an inherent trust within the system that UWM is, the platform UWM is, that if they send that loan there and something goes south, they can pick up the phone and get a hold of somebody. They can talk to their account executive, and they have like proper like escalation channels and things like that. So it's like there's trust within that system. Whereas like if you're a wholesale lender that doesn't have those sort of systems and processes and support system, like then it's like, I don't think it's fair to complain that UWM is getting that business. I think you've got to invest in your own platform to, and ultimately win that business over.
The retail channel for the longest time used to sell against the brokers by saying, well, they've got 35 people they could send you to, but we have one platform. And because we have one platform, we can provide you with the best and lowest interest rate. That was the argument against the broker. And we have all our in-house underwriting and everything is done in-house. And we have, if there's a problem, we know who to call. And now that some of the bigger wholesale lenders have figured out how to deliver that to their brokers, the retail channel is calling foul or crying foul. And I think that, that it's just noise. I think the brokers are doing their job to make a living and provide the best value they can to their customers. Just like you said, UWM is providing that. Rocket is providing that. Some others are providing that as well. And if you want to get in that space, figure out how to provide that, and you'll get broker business. It's that simple.
Bingo.
Okay, well, Coby, thank you for joining us today, Yoda. Last second plug before
let's not make that nickname stick, please.
Well, we got one more. We got to ask him a question, right?
Yeah, we got it. So, Coby, next week, everyone, we're not having an episode because the AI summit from Housing Wire is next week.
But will you guys be there?
Andrew will.
Okay.
Andrew will.
I'll see Andrew there.
So he's missing out. Yeah, hopefully you guys can connect. And then the week after that, we have the amazing Kevin Peranio having to follow you, Yoda. All right, wait, no, I'm making that stick. What is a question that you would like for us to ask Kevin?
My question is for Kevin is, what is his strategy for creating value within his IMB for the next 20 years?
Oh, okay.
It's a big one.
Yeah, KP, we're going to tell him too. He can't keep it. He got to open it up. Be honest.
And that's a question that I would ask him if he was on the show right now, because I am interested, and I know that he's a forward-thinking guy, and I really want to know from a lot of the IMB leaders, including him, how they see their role in the next iteration of this business, the next generation of this business. My secondary question, if you want to ask him, is what is he doing to bring younger people into the business?
Okay. I love that.
I'll give you two. You can use both, use one, whatever you want.
I think you also just made 2 LinkedIn posts right in front of us. All right, Coby, thank you very much for your time. Appreciate it.
Yeah, thank you guys. Really